Welcome back. In part 1, we covered the fundamentals of investing in a high-rate market. Now in part 2, we take the conversation further. You're about to learn the most profitable rental strategies for a high-interest environment, the tax tools that smart investors use to shield their income, the markets that continue to grow despite rising rates, and the cash flow systems that keep your investments stable even when borrowing costs spike. Rental strategies that work best in high-rate markets. Not all rental strategies are equally profitable when rates rise. In fact, the type of rental you choose can determine whether you thrive or struggle. High-rate markets often shift investor strategy from appreciation-focused investing to cash flow-first investing. Below are the rental strategies that typically perform strongest. 1. Long-term rentals, LTRs. In high-demand job markets. In uncertain markets, long-term renters provide stability. These renters often include healthcare workers, teachers, military families, government employees, digital workers. These groups tend to rent longer and more reliably. High-demand job markets provide lower vacancy, more stable rent growth, stronger long-term appreciation. Even in high-rate environments, certain markets remain resilient. Cities with strong job pipelines, areas near corporate expansions, university-adjacent neighborhoods, government employment hubs, logistic or manufacturing centers. These anchors keep rental demand high. 2. Mid-term rentals, MTRs, a growing goldmine. One of the fastest growing rental strategies today is mid-term rentals, properties rented for 30 to 180 days to traveling professionals. These include travel nurses, medical technicians, remote workers, project-based consultants, tech contractors, insurance placement renters. Mid-term rentals offer advantages: higher cash flow than traditional rentals, less turnover than short-term rentals, lower regulatory risk, a larger pool of responsible renters. With the explosion of remote and flexible work, MTRs thrive even when borrowing costs rise. 3. Short-term rentals, STRs. Still profitable if done right. While some investors fear street declines, the truth is, STRs are still profitable if located near tourism hubs, positioned near event venues, in cities with flexible regulations. Properly automated high-rate markets actually reduce competition in STRs because casual investors leave. This leaves serious operators with higher occupancy, reduced competition, better pricing control. Automated street systems, like dynamic pricing tools, help maintain profitability. 4. House hacking, a powerful tool in a high-rate world. House hacking remains one of the most powerful strategies. Offset your mortgage, lower monthly expenses, build equity, reduce risk. This works especially well in markets with duplexes, triplexes, or accessory dwelling units, ADUs. In a high-rate world, reducing your personal cost of living is a major financial advantage. 5. Build-to-rent, BTR, strategy. This is where investors develop new rentals intentionally designed for tenants who want single-family homes but cannot qualify for a mortgage. Advantages: high demand, strong rent stability, low maintenance, modern infrastructure, premium rental rates. As mortgage affordability drops, BTR demand rises. Operating expenses and cash flow management. In a high-rate market, your property's performance depends not just on income but on how efficiently you manage expenses. High interest rates amplify the importance of operational discipline. Here's how top investors protect their margins. 1. Master the 50% rule, then adjust the traditional 50% rule. States 50% of rent equals operating expenses, 50% equals potential cash flow and mortgage. But in a high-rate environment, insurance premiums rise, taxes increase, property management costs fluctuate, maintenance becomes more demanding. You must plan for higher expenses up front. 2. Underwrite insurance more carefully. Insurance rates have skyrocketed in many markets. Investors must Shop across multiple carriers, check disaster zones, surcharges, research historical claims, avoid high-risk flood and storm zones. A few $100 extra in insurance can destroy your cash flow. 3. Plan for higher repairs and AMP maintenance. Older homes cost more in electrical upgrades, roof repairs, HVAC replacements, plumbing fixes. High-rate markets favor newer homes with lower ongoing maintenance. 4. Vacancy buffers and rent protection systems. Successful investors maintain a 2 to 3 month vacancy reserve, automatic savings transfers, emergency repair funds, rent guarantee insurance if available. These systems cushion you from unexpected financial pressure. 5. Automate rent collection and expense tracking. Automation reduces missed payments, bookkeeping errors, late fees, tenant disputes. Tools like Buildium, Appfolio, Stessa, Rent Ready, Propertyware help investors maintain healthy cash flow. Tax advantages. Why high-rate environments are still tax-friendly even when rates rise. Real estate remains one of the most tax-advantaged investments in the world. This is where informed investors beat uninformed ones. 1. Depreciation, a non-cash wealth multiplier. Depreciation allows you to deduct the structure value of your property over 27.5 years for residential investments. This reduces taxable income even if cash flow is strong. You can be profitable yet report a lower tax burden. 2. Bonus depreciation, phasing out slowly. Even though bonus depreciation is reducing over time, cost segregation studies still offer big advantages by accelerating deductions. This is extremely useful during high-rate years when cash flow is tight. 3. Mortgage interest deduction. Ironically, higher interest payments equals larger deductions. This helps offset the cost of rising rates. 4. Repairs versus improvements strategy. Smart classification means repairs equals immediate tax deductions, improvements equals long-term depreciation. This distinction can significantly improve your annual returns. 5. 1031 exchange during high rates. Some investors hesitate to sell during high-rate periods. However, 1031 exchanges allow tax-free deferral on gains, repositioning into higher cash flow markets, upgrading into better performing assets. This keeps your portfolio growing even when debt is expensive. Identifying high-rate proof markets. Not all markets react the same to rising interest rates. Some markets slow down dramatically, others barely flinch. Successful investors look for areas with long-term demand drivers. Here are the top characteristics of high-rate proof markets. 1. Strong job growth. Employment is the #1 predictor of rental demand. Look for tech expansions, healthcare growth, logistic hubs, government facilities, corporate relocations. Job creation keeps cities thriving even when rates rise. 2. Population growth. Population growth consistently boosts rents, home prices. Demand for housing. States with inbound migration typically outperform the national average even during rate increases. 3. Affordable inventory. Expensive markets decline fastest. Affordable markets tend to stabilize or even grow. These include Midwest cities, southern metros, second-tier growing suburbs. Lower price markets tend to attract investors during high rate cycles. 4. Rental demand and homeownership opportunities. When mortgage affordability drops, renters increase. This boosts rent prices, occupancy stability. Investor leveraged markets with high renter demographics thrive. 5. Areas with limited new construction. If builders slow down due to rate increases, supply tightens, demand rises, rental prices increase. Builders often struggle when rates are high, but investors benefit. Predicting the next market shift. To invest intelligently, you must think one cycle ahead. Rates won't stay high forever, and when they fall, the landscape will shift again. Smart investors think in phases: high rates, now, best opportunities, negotiation, seller concessions, value add deals, creative financing, rental cash flow, rate stabilization. Markets begin recovering. More buyers return, inventory decreases, depreciation resumes, rates fall. This is the explosive wealth phase. Refinance into lower rates, cash flow increases, equity increases. Buying during high rate periods positions you for an enormous upside when rates normalize. That wraps up part 2 of our guide on investing in a high rate market. You've learned the rental strategies that thrive in a tightening economy, the tax advantages that keep real estate profitable, and the markets that continue to grow even through rising borrowing costs. In part 3, we'll break down advanced deal structuring, risk management frameworks, real investor case studies, and long-term wealth strategies that only seasoned professionals use. This is where the real power begins.